Hi everyone, I'm Jingjing Huang, credit strategist. Here with me today, we have our Asia portfolio manager, Stephen Chang. Stephen, thanks for joining us.
Thanks, Jingjing. Great to be here.
Let's start with the big picture. We just published our Q4 cyclical titled Tariffs, Technology, and Transition, which highlights a real clash of forces shaping the global economy. Can you tell us more about those forces and what do they mean for investors?
We see three major forces colliding. First, trade frictions gave the economy a temporary boost earlier this year as companies rushed shipments ahead of new tariff. That front-loading created a mini boom, but now we'll probably see a payback with additional risk that escalation can happen quickly again on short notice. Second, a strong tech investment cycle is providing a buffer. Spending on AI and infrastructure is helping offset some of the capital expenditure weakness elsewhere, especially in the US and China. Third, institutional challenges are adding uncertainty. Political pressure on central banks such as the Fed could increase volatility and widen the gap between winners and losers globally.
Given that backdrop of trade headwinds, tech tailwinds, and central bank easing, what are the key investment takeaways?
One big theme is locking in bond yields. Yields are still attractive, and with central banks likely to cut rates, we expect bonds to outperform cash over the coming year. So we have been adding some duration in portfolios, favoring short to intermediate maturities. This enables us to capture today's yield level while securing potential future income if rates fall further. Another key takeaway is that global diversification is critical. There's an unusual abundance of yield across regions, Europe, emerging markets, parts of Asia. By diversifying across regions and currencies, investors can fortify their portfolios and tap opportunities beyond the United States.
You mentioned China earlier. How are these global forces playing out in China? What's our outlook there?
China's economy is cooling. The export surge from early in the year has faded, and domestic challenges like the property slowdown persist. The PBOC has responded with targeted easing, and we expect more if growth stays soft. Chinese yields have risen recently, partly due to the rotation into equities, but we saw that as an opportunity. We added to our China bond position at higher yields, going overweight duration. With inflation low and monetary policy support still likely, we think those yields have room to fall.
On the corporate side in China, several large tech companies have recently tapped the bond market.
That's right. The capital market is open and active in Hong Kong. Tencent issued offshore bonds, for example, and Alibaba raised over $3 billion in a convertible deal. These issues receive a strong investor response, which tells you that there is confidence in those companies and China's tech policy push.
Clearly, China's policy and market dynamics are creating both challenges and opportunities. That brings us to a broader question. With the spreads so tight, how and where are we seeing values in credit?
Spreads are tight to the U.S. Treasury due to the deteriorating U.S. government balance sheet, while corporate issuers continue to show healthy credit metrics. We are taking a continuum view of credit, looking across public and private markets for relative value. Traditional investment-grade credit is expensive, so we're looking at other areas, such as asset-backed finance and other high-quality structured opportunities that offer more spread. We also selectively use private credit deals to capture value that isn't available in the public market. At PIMCO, we have deep relationships and expertise, so we can often approach issuer directly and structure deals to meet specific investment objectives.
Can you give us an example?
Sure. We work directly with a high-yield rated sovereign in emerging Asia on a funding deal. They needed to raise capital for strategic development initiatives. By anchoring the deal early, we secure a meaningful spread pickup over the public bonds. It was the same credit risk, but with differentiated pricing and structure.
That's a great story, and it really highlights how we strive to find extra value for our clients. Thank you, Stephen, for sharing your insights. For more, please read our full cyclical outlook, Tariffs, Technology, and Transition on PIMCO.com. Thank you for watching and see you next time.